Hello, everyone. I'm glad to be here. This is the third consecutive year we've had a chance to present at Hot Topics, so thanks, RJ, for having us. This is fun. Today we're just going to do a quick update, 15 minutes. So some of you I recognize from a couple past presentations. You've already been introduced to Beacon. Didn't want to go through the whole gamut again, but we will go back a little bit, just touch on some of the basics for those that have never heard us. One gentleman mentioned he read the book of our CEO. That's fantastic. But we're not going to get too much into the weeds. We're just going to really give you an update. So again, my name is Lou. Beacon Capital, we're a portfolio manager out of Dayton, Ohio. We're a boutique portfolio manager. We do something a little different than what most money managers do. You know, most money managers will buy and hold equities for their clients. We buy and hold. We participate in the markets. Right now, we're fully participating in this great run-up. It's been an 11-year bull market. We like to be a part of that, but we have a strategy to step away when the markets get, a bear market comes, for instance, almost like a train coming down the tracks. We want to get off the tracks, let it go back, and then step in. And I'll give you a little history of how we've done that in the past. So this first slide I'm throwing up, we want to be in the markets, right? Look at this. This is going back to 1871. It's pretty much a straight up line. So we believe in the markets on a long-term basis. But this is the same chart here, and it has these red areas that are called bear markets. And bear markets happen more frequently than you'd expect, and they last a little bit longer than you'd like, actually. In fact, the two recent ones you're probably most familiar with, the 2000 to 2002 tech bubble. You guys might remember the tech bubble. And then the 2007, 2008 financial crisis, right? So you had two that have happened in the last 20 years that were both over 50% lost bear markets. But here we are now, 11-year bull market. Has never happened before. This is the longest expansion in market history. And like RJ said, it makes you wonder a little bit. But geopolitically, look, the markets are on fire. From a debt perspective, though, we have over $23 trillion in debt for our country. So you look at both sides of the coin, and you're like, which way do we go, right? And we're just human beings. We're going to talk today a little bit about mathematics, but more so, we're going to talk about emotions, right? Most people that manage their own money, or even advisors that manage money, they get caught in the trap of emotion. Emotion gets in the way. And what we found is they often do the wrong thing at the wrong time, right? They buy high, they sell low. But we'll talk a little bit about that today. I think it's fascinating. But a bigger thing that is impacting portfolios today is volatility. And this slide on the screen here, this is showing how much more volatile this century has been so far compared to the last century. So the first part of this is 1950 to 1999, and we're showing the number of days that the S&P 500 declined by more than 2%. And there are only 160 days in 50 years. But this is updated through the end of 2018. There's already been 212 days just in the last 18 years, right, this century. And today, I just checked a little while ago, we're down 554 points right now on the Dow. So, that would probably add another one. So volatility is much more prevalent than ever before. And so many folks with the internet, invention of the internet, we're managing our own money. And we're not sure what to do with that. What we found, this chart right here is showing average rates of return per year. And it shows which year comes between 0 and 10%, 10 and 20, all the way to the right is 50%, all the way to the left is negative 30%. And you can see the blue line shows like a bell curve. The average used to be between 10 and 20%. But what we found over the last 20 years is that curve has moved to the left. So returns, not counting this year, or 2019, now the average is between 0 to 10%. But this is what Beacon's trying to do. We're trying to get rid of this, right? And we're not using insurance or anything like that. We're just managing a portfolio scientifically to go ahead. If we can get rid of this side, we'll have a narrower range of returns, and that'll be a little bit more easy for our clients to accept. Of course, if you get rid of the worst years, you're not going to get all the best years either, but being right in that middle zone allows a retiree to take their 5 or 6% for life and not worry about running out of money. In the last 20 years, there's been a lot of fear, fear, selling type of guaranteed products that come with big expenses. Sometimes it may not be needed. Just a little bit of smart investing is all you need to get the job done. Here's a slide that shows the last 10 bear markets. And the first one at the bottom is the Great Depression, 86% negative. Can you imagine if you had $100 and 86 of them are gone? That's what you have left. We remember that, right? And the last two, both of them, 52%, 49% decline. What I'm going to talk about shortly is that the power of losses are more powerful than gains. I mean, we love a year like 2019 where the S&P did over 30%. It was, a fantastic year for the markets. But if we turn around and lose 25% the next year, you do the math, you lost money overall, right? Such a wonderful 30% year, negative 25 isn't even as drastic as what we're seeing here. So give you an idea. And there's another graphic shows, look, those are great upward trends, but you lose half of your money it really affects. So math, we could talk math, right? It makes sense. Everyone will compare this and they'll compare that. But emotions is what gets folks, right? It's when last Christmas, for instance, if you remember last fall, from October 3rd through December 24th, the S&P was down 20%. My aunt over dinner was like, I'm getting out of the market, right? Well, the day after Christmas, the market started trending upwards, and it hasn't stopped since, right? So when did that investor get back in when they got out? And that's the bigger question, right? It's easy to get out, but how do you know when to get back in? And we see portfolios that didn't get back in till March or June, and some that still aren't in today, right? Still thinking it's going to turn at some point, and they're only frustrated because it doesn't, right? Just so you know, we run a portfolio where we get in and out of the market. We've been fully invested since mid-February. So we got out probably early December of last year. We missed 10% of the rundown, and we got back in mid-February. It worked beautifully for our clients. This is a great chart. In fact, I was just talking about this a couple minutes ago with someone, but this says if you lose a certain percentage of your portfolio, what does it take to get back to even? And we'll go straight to the right on this. If you lose 50%, what's it take to get even? 100%. We get people a lot of times that say 50. I go, you have 100, you lost half, now you have 50. They say 50%, I go, that's only 25. So now you're at 75, you're still 25 short. It takes 100. But the bigger issue is time. So the standard rule of thumb was if you do 10% a year, you double your money in 7 years. That's 7 years. You took 3 years to lose it, took 7 years to get it back. That's called the lost decade, right? A whole 10 years of getting nothing on your money. And that's the problem. Now we're 10 years older, maybe getting closer to retirement. So this is really a big part of everything we do at Beacon. This might be too small to see for you, but this is a fun little thought exercise. It's the difference between the old story of the tortoise and the hare. You guys remember the race, right? Tortoise is so fast. The hare is so fast. The tortoise is just taking its time, ends up winning the race in the long run. On the right, the hare does twice as much as the tortoise during good years. The hare does twice as bad during bad years. These numbers are just math. 12%, 6%. 28%, 14%. These numbers were actually 2000 to 2009. But somehow the hare does 2.6% a year. The tortoise does 1.3, but the tortoise ends up with more money. He has 108,000, and the hare only has 104. How's that possible? He did half as much on everything. And the thing is to get out of the way from the worst years. If you don't experience the worst years, you don't need as much to catch up, right? So it's a real interesting concept. Here's another mind exercise. You have two portfolios. Portfolio 1 has a 0% rate of return. Portfolio 2 has a 10% average rate of return. Which portfolio do you want? 0 or 10? You want 10, right? So let's see how it works. So portfolio 1 went down 10% in the first year. It went up 10% in the next year, right? That's 0% average rate of return. Portfolio 2 went up 60%. That's awesome. But then it went down 40%. Well, that's cumulative 20%, right? Which one do you guys want still? Right? What happens is the one that went up 10, down 10, ended up with 99,000. The one that went up 60 and went down 40 ended up with 96,000. Less money, which brings us to where we are today, right? It's a 30% year in the market. And as I said before, if you lost 25%, you're upside down. You're at $97,500 on $100,000. Not even counting 40% or 50%. If you went down 50%, you're back to $71,000. So these are really important things because people get caught up in their average rate of return, but they don't get caught up in how much money they have left, right? So it's a better thing to measure. Here's the emotions that your average investor experiences, right? Things are going up. I like this one up here. The guy with the green tongue. Yeah, killing it. This guy, I think I'm going to, that's not good. And it just goes up and down and up and down. And we'd rather see this. At Beacon, this is what our clients experience. It's just a smooth ride. What's our worst year? -7%, not 50%. What's our best year? Something like 25%, not 50%. But our clients just have that smooth ride through their investment period. Actually, one last thing on this. What if they're taking money out of their account? They're retired. So they lose 25%, and then they take out 6%. Now they're down 31%. So what's it take to get back to even? Something similar to that first chart that we showed. So we do, just real quick, what we do a real simple investment strategy. These are our 3 pillars of success. The first one is to maximize diversification. The second one is to minimize losses, to protect. And the last one is to maintain discipline, almost like a robot doing this. Think of a robot playing blackjack in a casino. Right? The best you can do is 49% because the house is going to win. But a robot makes all the right decisions at all the right times, and it gets as close as you can to that 49%. But the human doesn't, right? The human doubles down and quadruples, and I can't lose, right? Same kind of things we're talking about. So this is what we want to do. We want to maximize diversification, minimize losses, maintain discipline. So these are my 2 favorite words. I use it all the time. We want to participate. We want to participate in these markets. How many of our friends have been out of the market now for half a year or have been selling things along the way? Think of Tesla. Like 3 weeks ago, right? It was $300 a share. Now we're almost at $600 only 3 weeks later, right? People sold out. They missed those gains. But we want to protect, and that's the key, the protection part. But how do you protect? So the first thing, this is interesting, fun to know, the S&P 500, is that diversified? The 500 biggest companies, is that diversified? Do you guys know? It's 25% 25% technology, 15% financials, 13% healthcare. That's 50% of the S&P 500. That's why we really did terribly during the tech bubble, right? And the financial, not the same thing as well. Here's what we do. We want to go ahead and have an equal-weighted portfolio. This chart here shows correlations. So, you look at industrials are 92% correlated to the market, but utilities are 52% correlated. So they don't move in the same direction as the market. If you have 2 things that move in the same direction in the market, they go up with the market, but they go down together with the market, right? So we want to try different sectors that have different correlations so all your eggs aren't in one basket. Growth, value, and international, this is what you used to do, right? You go, I like growth, I like value, but no one knows what a growth stock is and what a value stock is anymore. There used to be a little bit more difference between growth and value, but now they're 95 and 94% correlated to the market. And international used to be 60%-ish. Now it's 87%. So it's almost the same thing. All your eggs are moving in the same direction, right? Your basket is a bunch of the same thing. So when that's out of favor, it's out of favor. So we just put 9% into each of those sectors. Sectors not just technology, financials, but energy, telecom, materials, utilities. Because some things do better during market expansions and some sectors do better during market contractions. And then we put a stop loss. We have a couple different products now since I met you guys 3 years ago. But we have an all-in where everyone's all in the market and we keep marking in the highs. And when we reach the last high, if we go 10% from that, we sell the portfolio. We get out of the way. And we just go into something real conservative, treasuries, right? Not going to make a lot of money on them, but you're not going to lose them. But if we get out of the way of a 50% loss and come back in like 2008 would have been a number at 9.16% positive, where your average asset class was -37, -38% loss. So it's interesting. We do these illustrations, and these illustrations we could customize. RJ knows how to do them. You can't really see that one all the way on the side, but again, the key concept is narrow range of returns, right? We want 95% of the time to never be more than negative 5%, right? And the same on the other side. We're willing to give up a little bit of the downside or the upside and not get all of the downside, and that's the key. And then does it work, right? So does it work? The S&P 500 is all the way to the right. You could have a year at 53.6%. You could have a year down negative 45%. So the second one next there, Vantage 2.0, it's one of our portfolios, can go as high as 50%, not much difference there, but worst case, negative 10.2%. Then we created a second portfolio, and it narrowed the range, and when you put them together, they narrow the range, negative 7%, top side 34%. You end up with a larger mountain of money if you do it this way than if you take that entire hit of what we are talking about. Clients that are taking monies out of their portfolio, there are articles talking about this S&P 500. How much can you take out of the S&P? Well, the S&P can go down 40% while you're retired. So they say don't take out any more than 2.8% ever, right? Our Vantage 2.0, it says you could take out 6% with 91% safety that you'll have enough money 30 years later to fund your retirement without spending extra fees using the insurance companies. Pretty cool stuff. And this is the old Peter Lynch, right? Magellan fund, greatest fund ever, right? 21.8%. S&P 16.2% during that period of time. Average investor only got 13.4%, and that's because they're taking it into their own hands again, selling at the wrong time, buying at the wrong time. So I hope that was helpful, just a little bit, but just so you know how our fund did last year, where the markets were up 30%, my personal portfolio in Beacon was up 15.1%. If you would have told me before the year started that we would have done 15.1% in a defensive portfolio, I would have said you're crazy. That was awesome. So 15.1%. We're fully invested right now, and we're watching this thing go. We've come back down about 4% since the high last week. So we'll see if we get the other 6% and stop out. Thanks for having me, RJ.